only slightly what we have said, because the most important part is probably what we expect for the future and why we do expect what we expect. So a key element will be the discussion about the stimulus, and we have seen yesterday the second biggest fiscal stimulus package passed the parliaments in the States in history. This will have an impact, obviously, on the economic outlook. We have, unfortunately, to cover the COVID situation. That's the big elephant in the room. The third wave in Europe, you will see that, but in Europe we can even talk of a third wave now, while in the States the third wave is there since a while. I thought we revisit, on one hand, the Schiller PE, what it tells you, and for actual reason, Schiller has updated with two core authors his theory he invented, in brackets, the excess Cape yield, and comes to the conclusion that if we take his yield measurements in comparison to bonds, maybe markets are not so irrational as we might think. And as usual, I give you my favorites over the coming weeks. Different maybe to the last 3-4 times. I will be, on one hand, a bit more cautious because I start to be consensus. That worries me. But on the other hand, after you will have seen all the slides, probably will understand that it is quite difficult to have another view at the moment. But I'm really a bit scared, and probably it's fair to say at the beginning, the future is probably brighter than the past, but a pullback and or correction can happen anytime. With that, let us look back. If we look first for bonds, I mean, globally speaking, the more risk a bond market has, here measured by the Bloomberg Barclays indices, you see the return was 5% plus. If we go more to the investment grade area, it was more 1 to 2%. Not shown here, US Treasury have had a return above 5%, which is amazing, but it was outpaced by TIPS, by inflation-protected government bonds from the United States. If you look at this just today, obviously it looks like we had a nice year, little volatility, just a straight line up. Unfortunately, we all know all these bond market and indices, and together with the equity markets, they were sharply down in March. So, for instance, the US high yield index was down more than 5% and is at the moment trading above plus 5%. So there was a tremendous rally in between and a lot of volatility. I was positive in spring after the lockdown and the correction, but little did I know that we will see such a tremendous rally. And the same holds true for equity markets. Equity markets in March were significantly below zero. As you probably remember, we favored the US and Asian markets. They both have delivered a very good return. The Nasdaq is an astonishing 46% plus. The S&P, driven by FANGs, is up 16%. MSCI World and MSCI Emerging Market, this is probably the most astonishing, are similar, up around 15% measured in dollars. However, most of the performance in emerging market happened in the last 2 months, driven first by Asia, but then catch up, as you will see in the end, with other emerging markets like Brazil and Russia and India. Europe had a poor year. We would argue, although the market is cheap and continues to be cheap, it will probably underperform or maybe perform in line with our favorite markets. This due to structural changes, this due to missing reforms. Although the fiscal package and the monetary package decided in the euro area is so big that there will be definitely positive returns. Nevertheless, we would still prefer other areas. Also remarkable is that the Nikkei is now on a 30-year high. It was also positive for the year, more than 13%. However, for all these markets, I've said it before, the path was not smooth. It was really a tremendous correction, a crash actually in 2 weeks in March, followed by a 9 months recovery, and the year will most likely end on a very positive note. If you look at commodities, gold year to date up 23%. I could say as expected. However, there was a sharp correction in between, and gold has delivered what it should deliver, a certain protection, but the volatility is probably unprecedented. More surprising is the rally of copper and industrial metals, not shown here, other industrial metals. This is probably due to the expectation that the global industrial production will rebound and will continue to rebound. Oil year to date down sharply, however, over the last 2 months up more than 15%. This for me is really the surprise. I was slightly positive on oil last time, also because the futures curve were in a way that if you were to invest into products, you wouldn't have your roll losses. Nevertheless, never would I have dreamed that we would see such a tremendous rally over 6 to 8 weeks, and with it a lot of emerging markets which were more commodity driven have recovered sharply. So that one I really missed out, but it tells me that the rather constructive outlook might have various sources, be it copper, be it oil itself, or be it other industrial metals. Overall, the commodity complex is down for the year roughly 5%. On the currency side, I would say the strength of the ruble is a big surprise, and the weakening of the dollar was expected, might continue, but it's an extremely crowded trade. The real winner, however, this year were not gold or tech. Both had tremendous inflow. Here you see the inflow year to date, but the real winner was cash. Although cash doesn't deliver you any return, but it was the asset class with the biggest inflow in 2020. This is extremely amazing, given the world we live in. This chart we had last time, the intonation I would like to change this time. So for a start, we have a lot of monetary stimulus. We have a monetization of debt. There is a new word for it. We call it modern monetary theory. But basically what it means, you see on the left-hand side, 62% of all the Fed finance need was basically bought, of the treasury needs was bought by the Fed. Or to put it in simple terms, the budget in the States was basically financed by printing money. You see that underneath 613 billion of notes were bought by the Fed. That's more than was issued the whole year. What this led to is what I call financial repression. We come to that in a second, but basically you see that there is no inflation. You see a lot of nominal and or real negative yielding bonds. So an expropriation of wealth of private individuals. The key question is why all this stimulus didn't work. And the answer I gave you last time is we are in a balance sheet recession. I might add with a little twist. The twist is that the fiscal packages this year were mostly, at least in the US, saved by the private individuals, but also the corporate sector does not invest. It rather repairs the balance sheet, repays debt, and therefore the question is how you get out of such a situation. The answer is fiscal stimulus. We had a similar situation in the 30s. There you call that the New Deal. The Fed at that time didn't print any money, and the little which was printed was by far not enough. By the contrary, they even tightened during the Depression the money supply. The reason why a lot of economy came out at that area was the fiscal stimulus. Leading the pack was Germany for sad reasons, because we had in the end World War II. But this unfortunate situation forced the US to invest significantly. And as sad as it sounds, but the investment into war helped for prosperity in the US and set the ground for the growth which was coming in the 50s. And by the way, the 50s was an area of financial repression. And these four themes must somehow be touched, and these four measurements must be put in a nice policy that they fluctuate each other, that they stimulate each other. And if one leg is not strong enough and or not used, then we have a situation like now. There is no inflation. However, there is a huge amount of money printing, and the velocity of the money is dropping, and it was dropping this year to levels last seen in the 30s. Here we go back to the Great Depression. And the reason I bring that is the way out was at that time fiscal stimulus, because there was no money printing, and there was also yield curve control. To put that in another perspective, you see that the debt building up over the last 10 years, the advanced economies are almost at levels seen after World War II, which then was followed by fiscal stimulus, by financial repressions, and in the later on in the 50s by also monetary stimulus. And one key message here is, if you want to get this debt to GDP ratio down, and you don't want just to cut some zeros and to do a reform of certain currency areas, you need a long period of time where you inflate away, or if I might reuse, if you use financial repressions to get that level in real terms down. In the emerging market space, you see we have as well seen a build-up of debt to GDP, or of debt in general, but the level is still contained and below 70% in most cases. With that, we come to the economic outlook. We had recently the OECD, we had regional governments, they have basically reduced their GDP forecast down. The OECD says that from previously 5% global growth down to 4%. My assessment, my take is similar to what I've said in spring. First, we cannot know, but second, I do believe they are too cautious. On the other end of the spectrum is Goldman Sachs. They have increased their GDP forecast for the US to almost 6%. China is expected to grow more than 5.5%, and both are more than 40% of global growth. Europe is set to recover. However, you see that in the chart, in the light blue and in the green, the pre-crisis level most likely won't be reached in Europe over the next 12 to 18 months, while in the US, we will reach probably at the end of H1 levels. We have seen total levels of GDP like before the pre-crisis. China is already there. China is booming. China is above that level. Therefore, my take is that the global GDP growth outlook is probably more on the 5% side than on the 4% side, like the OECD said. But obviously, the elephant in the room, and we come to that in a second, is the development of COVID. So far, the impact on growth is limited. The impact on the stock exchange is even positive if you were to do a regression analysis, knowing that this is not really serious. But what I would like to say is that all these sectors which are, for instance, in Europe locked down, they are not at the stock exchange, and they are between 5 and max 15% of GDP, while other areas of the economy, especially in the industrial area, is performing extremely strong. And the service sector, the latest PMI data in Europe were weak, but they were much better than 1 month ago, although we are in the second lockdown in most countries. Another reason to be positive is this chart. Here you see the goods shipped to Europe and to America from China. I am personally astonished when I look at this chart because I see a vertical line. That means that not only does China produce and consume locally, but also they have managed in 2020 to substantially increase their export, even to the United States, although Mr. Trump had a lot of tariff conflicts, and that is astonishing to me, but it tells me that the real growth we can expect, because this is real-time data, not yet reflected in GDP, the real growth is probably going to surprise. PMI data from China are on a 10-year high. The history of this PMI data is much as much as 20 years, and the reliability 20 years ago to compare to today is probably weak. But the remarkable point here is we have seen there all PMI data above 55, so that's the acceleration area. And as shown before, this is not just consumption, which is one of the pillars of the future industrial product politic of China. It is also export driven. South Korea, not shown here, has shown tremendous export growth, while the import was rather stable or slightly shrinking. So Asia is going to be in the next 10 years the place to be invested. And if I quote Ray Dalio, co-founder of the largest hedge fund in the world, he believes that the next superpower will be China. The US will lose a certain amount of influence. However, he doesn't foresee, and I agree with that statement, for the foreseeable future, the reserve currency of the world will stay the dollar and will continue to be the dollar. I don't see that the euro can jump in, and the renminbi at the moment is not fungible enough. There are 3 different currencies in China, and it is not free accessible. So for the foreseeable future, the US dollar will probably stay the reserve currency of the world, but the next superpower will be in China, and obviously the lead lies in China itself. I mean, Asia leads in China, but also India is picking up and other areas. So this is also positive for growth and probably must be reflected in market prices. For the US, personally, I'm astonished that the 10-year yield of the government bond stayed below 1%, but at the same time, the yield curve steepened. That means that the Fed was able to dampen and to reduce the yield on the shorter end. And if bond markets have any prediction power like they used to have in the past, or at least over the last 40 years, then this means 2 things. A, the recession in the US is probably over, and B, there is an acceleration of growth. Dr. Copper says a similar thing. As you know, we had a tremendous rally in equities and bonds in November. If you look at the price development of copper during that area, and since then in December, it tells us that there is a lot of demand for copper. Copper is used for electronic equipment. It's still one of the key ingredients. So even Dr. Copper is telling us that there is acceleration of growth. However, the elephant in the room is the pandemic. Look at this chart. This is the Spanish flu, first wave, second wave, and now it comes the point I would like to make, the third wave. It is sad to say that although we read and we heard in the news, we have learned we can do corona, we know how to deal with it. Actually, the second wave is here, and in some areas, you see that on this chart, the blue line, so Spain, France, Germany, Italy, and the UK, we are seeing an acceleration and a building up of a third wave. And the sad point here is these 5 countries, actually, they are all in a lockdown. And it seems that the lockdown is not preventing the spreading of the virus. And the measurements seem not to work. The light at the end of the tunnel, obviously, is there is a vaccine, and we have started to vaccine people. But logistically speaking, this will take a lot of months till we have globally a herd immunity. So until 50% of the population is vaccinated, unfortunately, this will take longer than just 1 year from now. What you can also see is that in the US, there was a first wave, a second wave, a third wave. It never stopped, and now it continues to grow dramatically. The new president of the United States tries to address this, but obviously he is only in charge at the end of January. But this development must be contained and controlled. But on the other hand, it didn't hinder the economy, with the exception of leisure and certain service area, to grow. The price is high, actually. Today, unfortunately, the most people ever died in one day in the United States, and there is unfortunately no end. If, however, we are going to continue to see this kind of lockdown where production is kept alive and services, with the exception of restaurants, cinemas, etc., is open, the impact on the economy is minor. Nevertheless, the impact on the society, the state, how you feel, is very negative. Recently, I came across a study done here in Switzerland. They measured how many people have kind of depression and don't feel too well. In the first wave, we started at 3%, went up to 10%. Over summer, there was a reduction to 7%. But now in the second wave, and maybe soon in the fourth wave, unfortunately, we have reached levels that 20% of the population feels stress, feels unwell, feels kind of depression, and this is really the concerning bit here. Plus, obviously, most people do know people who were ill and or have unfortunately died. I'm not a virologist, so I stick to my indicators, and they tell me a story that there is growth and there is money. I have shown this chart in the past. I would like to make two statements. First, over 3 years, the white line, that's the inflow into equity, is basically flat. So there was an outflow and an inflow, but over the last 3 years, net, there was no additional investment into equity, although over the last 2 months, you read almost weekly that there is record inflow into equity products. But if you looked at over a 3-year time horizon, we are net flat. The winner, unfortunately, I said that before, but the winner was cash. So the amount of cash has piled up, and what was not in cash went into bonds. This is the global flow. Over 3 years, I found also this chart. It is only 2 years. It's the same figure. It tells you the same story. So basically, over 2 years, equities had outflows, including the recent inflow, and there was a tremendous inflow into bonds. We are at levels before the COVID. And the cash pile is there. It went up significantly, and it's slightly rising. This money needs to be deployed. Ray Dalio said it several times, cash is not a safe asset class. That's probably a reason to be constructive for risky assets, although they are not cheap. What all these measurements, these stimulus brought is twofold. We have a negative yielding bonds, mainly in euros, in Swisses, in JPYs and cable, of almost 18 trillion. We had 190 rate cuts globally this year, 190. So on average, each country at least once cut their rates. And Ray Dalio makes the point, I said it before, that the investor is lulled into a false sense of security because from a US dollar perspective, the US dollar is the reserve asset of the world. He puts that in doubt. He claims that it will be going more towards China, that the euro and the renminbi will play a bigger part, but this new superpower will be in that area, and the money should be deployed more there than domestically, i.e. in the US. And if that's not enough, the US is facing now the problem that treasuries, after adjusting for inflation, have a negative real yield of 1%. This is nothing new. I've shown that chart last time. In the meantime, the negative yield is roughly 0.9, but the key message stays the same. If you invest in safe government bonds, you lose either in nominal term or after adjusting for inflation, you lose money. And last but not least, when you get your coupon, on top of it, you pay even taxes. So where to invest in the bond space? I'm a bit sorry to repeat myself, but if you want to stay in the liquid space, you see corporate investment grade bonds have a yield to maturity of 0.38%. So that's almost zero, again, before inflation. It's probably not really a lucrative investment. On the other hand, global high yields give you a nominal yield of roughly 4.3%. A US high yield, in brackets, only 3.8%, and emerging market hard currency bonds are even below 3%. Nevertheless, if you were to invest into bonds for a return and not for diversification purpose, you probably cannot ignore corporate bonds in the double B or sometimes even single B area. I'm talking of hard currency bonds. I would like to add, probably there are opportunities in local currency bonds, assuming that the dollar is further weakening and you calculate your return in dollar terms. This is not our expertise, therefore I'm not going into more details here, but I believe there is definitely an area where you can invest. Turning to equities. Normally, at this time of the year, it's very simple. I have shown this chart before, including November and December. Seasonality speaks a clear language. The seasonality basically tells you should invest into equities, and the return November, December, January, further on into spring, on average, is positive. This chart even includes 2008, so it's an average return. But if you follow strategists, and now it comes my concern, everybody tells you that, so I'm a bit scared to be in the consensus camp. I see, unfortunately, no other areas in the liquid space to invest. There is private equity. I came across a statistic today. There is $1.5 trillion parked in cash into private equity vehicles. 1.5 trillion. That's amazing. And this money will be deployed in the private equity space. But it shows you also there, on one hand, there is no alternative to invest into risky assets. but the expected return and opportunity set is extremely limited. Otherwise, the private equity company wouldn't just pile up cash. Why I'm concerned is also well shown here. The red area shows you perma-bears. They are strategists who are always negative, and the gray area are economists who are most of the time negative. They both gave in, they throw that towel. They are now at least neutral or bullish. This is really scary. But again, the alternative set is really limited. This chart gives you two important messages. One is that the one the producer of the chart wanted to make. The rally was driven by more than 90% of all stocks in the S&P 500, so that's the good news. Not only the FANGs, but the recoveries, in particular in November, was driven by almost all stocks in the index. The bad news, obviously, is every time that happened, this was followed by a pullback and or correction like this year in March. I would like to stress a second part, which I think is, for me at least, more important. The rally is broad-based, and we have seen a sector rotation into small caps, cyclicals, and to a certain degree values. I would call that healthy. Therefore, I believe that the forward-looking returns are probably positive, and next year might be another good year. However, there will be most likely a setback, or just to put it in simple terms, the volatility is probably going to come back. Here is another reason why I'm more cautious than previously. The white bar shows you all single stocks calls, and the blue one puts. Both are at record levels. However, most people are bullish. They speculate on rising stock prices, and at least 20% of the US stock market is nowadays driven by retail investor, by Robin Hooders, by investors who have never probably seen in their lifetime a crash, never lost money. Most of them invested only after the crash in spring. That's another reason why I do expect a pullback, and I repeat, a pullback, so 5 to 15%, even a correction, but I would not foresee a crash for the time being due to the massive stimulus we see globally, fiscal and monetary. The last reason why I'm cautious is the Bank of America, former Merrill Lynch fund manager survey. Professional managers who manage equity products have now a cash quota of 4% or slightly below. This was, at least in the past, always a good indicator for a correction and or crash, normally more a correction. So also that one puts you in the camp of being cautious. But I repeat myself, the alternative set is limited, so I would stay invested. I would be broadly diversified. Why this? The simple point is we have a PE of roughly 25 in the US. That gives you an earnings yield of 4%. And those of you who are familiar with the risk premium, if I subtract 1% for treasury yields, I still have an equity risk premium for the US market of 4%. If I were to do that with real yields, it even goes up to 5%. Real yields, we come to that in a second. That's the concept Schiller uses. So if we compare that to bonds, that's the straightforward analysis. That's what every equity analyst and strategist will tell you. Equities are compared to bonds very cheap. There's not much to say if we just look at the figures. Let me open a bracket. There were 3 times in the period when the markets were so expensive. One was in 99 .com bubble. And interesting one was in 1921, just after the pandemic, just before the tremendous rise in stock market up to the crash to 29. There was a disruptive economy at that time. So you had mass production of car, you had mass production of simple things like a fridge, like an electric iron. You had the telephone, you had radio, you had the ticker for the stock market, which got more or further developed. And all that ended up, as we know, in euphoria. But what's amazing, at least for me, is that before we have seen the tremendous rise of the market globally, markets were expensive, similar to today. So even if we are expensive, it's not completely to be ruled out that we can go up from here further and that the PE down the road might be much lower. Why do I say that? There is a possibility that we have a similar situation like in the 20s, given that the disruptive economy is here. So we are talking of artificial intelligence, Internet of Things, digitalization, just to mention some keywords. This has led to the FANG stocks and other tech companies to go through the roofs, but also new clean technology, new accessible clean energy products went up through the roof. There is an index in the US who basically tracks stocks which invest into clean energy. Year to date, the return is at 150%. I repeat, 150% in an index who just tracks stocks in the clean energy area. It has obviously also led to exuberance like Tesla. I would argue that now, as Tesla is in the S&P 500, it will underperform for a while. However, they have a certain technology edge, and they have a certain advanced and in terms of the concurrence. So I cannot rule out that after a certain mean reverting, Tesla continues to do well. Now, this is a bit the lecture part for all CFA guys. The famous Shiller, Robert Shiller, who won the Nobel Prize, has, let's call it, enhanced his Shiller PE or CAPE PE. Basically what he did, he said, if I were to calculate earnings excess yield by taking from the Shiller PE, which is roughly 33 in the US, the inversion, I get 4%. If I compare that to the real yield, where is 3%. If I compare that and I calculate the risk premium, so Shiller yield, excess yield, or Shiller yield of 3%, I compare that to the 10-year Treasury yield in real terms, because Shiller works with 10-year real data, backward looking, then I get an excess yield of 4%. And if I compare that with history, he claims that over the last 50 years, that's roughly the average. Therefore, the conclusion of his paper, together with two co-authors, is that although the high CAPE ratio, or Shiller P, if you will, we can argue that valuation compared to bonds may not be as absurd as some people think. This is obviously true for the time being, and we don't know how the US bond yields will develop. But I have two thoughts on that. On one hand, it's the elaborate way of what I've said on the previous slide, that the earnings yield in the US is 4, and therefore, we can argue that with a more sophisticated measurement of Shiller, we get to a similar conclusion. If he does the same calculation for the UK, Europe, and Japan, you see the figures there, we get a 10% and 6%. Basically, the message is crystal clear. That's a high figure. Equities look cheap. China, the history is not so long, but with the actual data, he gets an excess yield of roughly 5%. The only thing I would like to throw here in is the following. If we were to take the actual Shiller P of 33 in the US and look in history what happened when the Shiller P was at that level over the next 5 years, the conclusion is the stock market over that period was returning a negative total return. Or in the Shiller original paper, if you were to see that, his conclusion were if Shiller P is above 30, the forward-looking return is somewhere between -1 and +3, depending a bit on the time window. I try really to avoid this time is different, but this time might be similar to the 50s. And there we are back to the starting point. Financial repression, yield curve control, implicitly we have that with the Fed QE forever, balance sheet recession as a starting, and now finally another fiscal package, almost 5% of US GDP, and there's more in the pipeline if both parties agree, and or in January there's still a votation for 2 seats in the Senate. If the Democrats win, we even have a mini blue wave and there would be more stimulus ahead. So therefore, I tend really to agree with this conclusion that at the moment the valuation is not as absurd as it looks like at the glance, but I'm really a bit scared that nobody is really bearish. I said it before, and I came across a chart where the Euro Stoxx 50 and the Dow Jones was compared, and I didn't do that on purpose because basically you would see that the Stoxx 50 up to now is flat, and then basically that chart claims from 24 on to 1929 we have a quadruple of the value. I think you should not compare Europe with Dow data. Nevertheless, it was too tentative, so I did the same data mining exercises, and I really played around to get something which looks in brackets reasonable, and this is by no means a forecast, but it's to illustrate when you have a disruptive economy, when you have change of technology and growth and compounding growth, our brain is not made to understand that. We are not able to imagine that. You see that in the orange line in the pile, and you see that to a certain degree in the green line, which is the Dow from 2006, so including 2008 till now. I repeat, the period 2006 to 2020 is really random. I could have chosen it differently. I don't know where we stand. But to freely quote Einstein, he thought and said that compounding return should be the 8th world wonder, because it's something we cannot imagine. If you were to compound returns over 10 or 20 years, only by 4%, you get sooner or later a curve which goes vertical. And the human brain is normally erroring on the negative side. Having said that, I believe that the forward-looking economic development once the pandemic is under control is probably going to be a further changement towards digitalization, etc., and that will be reflected in the stock market. If that's going to happen over the next 1 year or 5 years, I really don't know. But for 2021, I would bet that markets will continue to go up with hiccups/pullbacks. Coming to the dollar, also here, most people, including myself, and I would not claim to be a currency expert, expect a further weakening of the dollar. It's the policy of the United States. They want a weak dollar. It boosts their economy to a certain degree, and they're saying is still true, $1 is $1 and your problem. It's the reserve currency of the world. If that were true, if we were going to see a further weakening of the dollar, obviously investments in local currency bonds, we had that before, from emerging markets and in emerging markets in general, should do well. The oil price had, over the last 2-3 days, a little correction due to the mutation of the virus. I'm also not a commodities expert, and especially not an oil future forecaster, but this chart and everything I hear, and if you believe that the economy is going to continue to grow in 2021 and might further out continue, oil is probably going to trade between, let's say, around 55. That's quite the level from here. And with that, obviously, emerging market equities where oil is produced, and Russia is one of these countries, might have further upside, although we have seen recently a rally. So I'm rather constructive on oil, given that I'm constructive on the economic outlook. I would also include gold, and we had that before. Last time, I think it was written, we are probably going to test the 200-day moving average, and I hope that we are not going really to break through. We went below that level. Nevertheless, in the meantime, as you can see, we are restarting an upwards channel. I personally would add gold to the portfolio as an insurance, so physical gold in one way or the other. And if you were a speculative person and or want to substitute some equity with gold mining stocks are still trading compared to their own history at reasonable prices. One can even argue slightly cheap. So gold is definitely an area, be it physical or be it through minings, which you should consider. Last time, I was reckoning that we might see a catch-up trade in Brazil. So if you see the orange box, that's the return since the beginning of November. Brazilian equities were up 38%. We have seen the sector rotation in the US, the Russell 2000, over 2 months, 28%. And we have seen, but not expected, not discussed, the Russian market was up almost 27% since the end of November. So emerging markets, short term and year to date, that's the total return in the middle. Asian markets and the US did pretty well. I continue to believe that emerging markets, not just Asia, in 2021 and the US will do well. Like said last time, I would put the intonation more on Asia, and this time I would tweak it. Even if you were already in Asia, consider adding some Russian exposure, some Brazilian exposure, some exposure to countries which are exposed or profit from commodity prices, be it oil, be it industrial metals, be it other soft commodities and or industrial metal in general. I must also repeat, obviously, that hiccups are to be expected. I find it amazing that the Nasdaq 100 is up 46%. Nevertheless, over 2 months, it has underperformed almost all markets shown here. I would expect that the sector rotation next year continue. So Russell 2000 and emerging markets, but I would definitely not bet against US technology. Having said that, in emerging markets, in particular in China, there are a lot of technological leaders. So if China goes up, it is fair to assume that their technology sector would perform as well, pretty well. Last but not least, MSCI Europe was measured in dollar terms flat for the year, has significantly underperformed, and if we were to calculate the performance in euro, we are roughly down 5%. Europe is cheap, was cheap, is cheap since 2008. It can definitely catch up, but I would definitely first overweight emerging markets in the US before I start allocating to European equities. The UK market is an exception. It is even cheaper due to the Brexit discussion, or rather non-solution so far. The latest news today was that there will be a kind of mini solution between France and the UK, and maybe even with the European Union, that at least the trade and the traffic through